So the original topic for this video was actually going to be why overcomplicating your backtest fees was a waste of time. And I actually ended up researching myself out of this conclusion when I sort of discovered how important this is and how in depth you can go and probably should go to get a better idea of how your strategy will perform. You don't need to overcomplicate this, but many people do and probably waste a lot of time doing so. So I'm going to show you in this video how you can do this easily, not spend too much time modeling these fees, and get a pretty accurate idea of how this might affect your strategy without spending a ton of time doing so. So fees are kind of the lost child of systematic trading. They are often ignored because they're unattractive, and they often will ruin your strategy's performance in backtest as soon as you implement them. So I feel like people tend to have a tendency to sort of shy away from implementing them, just so that they can retain their strategy's performance and claim that it has alpha and such. But unfortunately, in the real world, they exist, and so you won't make any money unless you model them properly. So the reality of the situation is that these heuristics cover 99% of cases on IBKR if you are trading ETFs and equities. If you use a different broker or trade a different instrument, you're going to have to do your own research as they have different optimal setups depending. So right off the bat, if you trade more than 3 million shares a month, that's a pretty sizable trader. I recommend just using the tiered system at all times, because no matter the situation, even if you are using only market orders, you're taking liquidity off the market, you are still going to be getting this really low cost per share. And even though the third-party fees down here are passed on to you, you with that really low broker fee, you still net a better price per share than the fixed plan. So these are the inflection points for the small trader. So as you can see here, we're trying to find the number of shares where the commission costs are equal. And if you are in tier 1, that happens to be 149.25. So if you are over that, then it makes more sense to use the fixed system. For a tier 2 trader, so between 300K and 3 million a month volume, it makes more sense to take the fixed system in block sizes over 192.3. So this actually really depends on the price as well of the share, because if you have a small account and you're trading large denominations, large shares prices, you can only use a few shares at a time. So that might force you into the tiered system. But if you're trading lower priced stocks, then the fixed system makes a lot of sense. So as a general heuristic, I would recommend if you're trading penny stocks, so below $1, you should for sure use the fixed system. I'll show the example in the calculator after. Also, if you're using limit orders, always use the tiered system. This is going to be better. It's cheaper always. Regardless of buy or sell side, if you are using market orders, you're going to be paying for liquidity. And if you're using limit orders, you're going to receive often a rebate for providing liquidity for entering an order on the market book, which is good for the exchange, and they will normally give you a rebate for that. So always use the tiered system for that. Now, here's the summary table down here. This is for liquidity takers. So this is people who are making directional bets and entering trades immediately as soon as the signal shows up. That's a lot of traders if you really think about your strategy. So again, as I said, the inflection points are at these two values. Most people will probably use the fixed plan. And if you trade a lot, then just use the tiered plan, very simply. So as you can see here, this is the calculator I have the number of shares set to 149, so you can see the tiered plan is still just a little bit cheaper. But as soon as you hit 150 shares, then the fixed plan becomes cheaper. And if we bump ourselves up into tier 2, so that's at 300,001 shares, 150 shares is now your block size is now, the tiered plan now becomes cheaper. So if we go up to 192, you can see here that the tiered plan is still cheaper, but this is the inflection point. So at 193 rather, we've now got the fixed plan is cheaper. So you can use this calculator to try and figure out on average which one's going to be better. A lot of strategies combine using limit orders and market orders depending, so you're going to have to figure that one out by running a simulation of your strategy and potentially seeing which you have more of or which one are more impactful on your fees. So that's another consideration. So another important aspect of your strategy is going to be its turnover and trades per year. So these give you an indication about different types of fees, as I mentioned before. So we already looked at the fees that come from your broker, the exchange, and the clearinghouse, and regulatory fees, but we haven't looked at the fees that come from things like slippage and spreads. So here's how I look at turnover and average trades per year, or it doesn't have to be trades per year. It can be trades per week or trades per month, depending on how much data you have. If it's a really high frequency strategy, then maybe you would want to look at trades per week or trades per day, for example. Let's say that you have very high turnover, but low trades per year. This would be an indication of really massive individual trade sizes. So you could be turning over one or more of your entire account in per trade. If you have lots of little trades, you would have high average trades per year, and then you would have lower turnover. This would indicate that your fees are coming from fixed costs. So as you can see on my screen here, I have a strategy here that does 1,581 total trades over 7 years. So that's around 226 trades per year. So this strategy, I do not simulate like an account balance, so I don't actually know my turnover, but I can tell you that if I was trading this, I would have a small account size, and I would be more concerned with the total trades and average trades per year, because I would most likely be dealing more with high fixed costs rather than variable costs. On the other hand, if you're turning over your account in large amounts, you would see high turnover, and you would need to worry more about slippage and spreads, and you don't really have to care too much about this number here of trades per year or trades per week, or whichever time period you choose. Okay, and another important factor is liquidity, market impact, and availability. So liquidity and market impact sort of go hand in hand, because if you're trying to simulate liquidity and you have decent size, so this is more important for a larger trader, the problem is that you have a hard time modeling your market impact because the historical data cannot change and is very hard to model the changes in backtesting. Rather, we don't really model those changes. Some very sophisticated backtesting software and proprietary backtesting systems that like hedge funds and such would use do this. And this is not really something that somebody with a small account should need to worry about. You should more or less focus on, is the market you are trading liquid enough to not really change much for you? So if you're trading really, really illiquid markets, this can be a concern, and you should be skeptical about results that do not include the impact of liquidity. So just to give you an idea, you can see here a lot of the tickers that I was using in this example that I've been using throughout the video are very small micro caps. So you'll see that right here, the volume is extremely low on this particular company. Not actually horrendously low, but so very small traders might still be able to trade this market, except comparing it to something like Apple, very, very liquid, right? You have 28, almost 29 million volume. And so this is something that you should be considering because it can really impact the way that your strategy will actually perform in real life, not in the back test. So either you have to model this, which is quite difficult, or you have to make a decision yourself, basically. So for me, I generally do just decide, okay, is this liquid enough for me to trade without really modeling this? Do I have to worry about this? So, for example, although this stock here, ABIS, is illiquid at the moment, the study right here, it was a gapper study. So the point at which I would be trading this stock would be during a time where there was a lot of volume. You can see right there in column 4 that the pre-market volume every single time is extremely high. So it wouldn't even be something I would really worry about, especially if I was only holding it for a small period of time. So in this case, I would be okay. Let's say you're trading something like some government bonds in some obscure country. This might be something that you want to worry about in this case. And finally, we have availability. So availability is basically whether or not you have shares or whatever asset you're working with available to borrow. In my case, when I first started my study, I actually did not know the availability of my shares or the fees, the short selling fees. This is another thing. And I did a back test on QuantConnect, and it came back with extremely good results. And the reason for this was that QuantConnect by default does not model short selling fees or take into account availability, so it would let me just short for $0 basically, and come away with a huge profit. So this is an actual constraint that real traders face. Well, not real traders, but rather, traders who are trading on the actual market with real capital. This is a thing that they face. So that's why I had such high returns and good results from that, was because it's a completely unrealistic result. So yeah, going a little further into that, you can see that the borrow fees, they're in decimal. So right there, for example, CNET has over 100% annualized borrowing fee. And many of these tickers at the time that I wanted to borrow them to short them had no shares available. So when I did incorporate this, the strategy became completely intractable. It made no sense anymore. And so I had to pivot the strategy. But basically, the point is, you need to know this for your strategy. This is one of the biggest mistakes that people make when doing fee modeling and backtest modeling. You should know, especially if you're going short, especially on stocks. If you're going short on futures, for example, where that's extremely easy, there's very few limitations. You don't really have to worry too much about it, just liquidity. But this is a big deal. So yeah, you can see here that I did just a quick inspection of my data, and I saw that the percentage of events that had no shares available was around 50%, so half. And the annualized borrow rate was 53.46%, which is astronomically high, meaning I would need to have some insane returns to make up for this, and they didn't. So just be aware of this, especially you could get really destroyed by these fees if you did a naive back test without implementing them or understanding them, and then deployed some money on a strategy that relied on shorting without actually understanding your availability. Okay, and the final thing is capital efficiency and scaling. So capital efficiency is basically how long are you locking up your money for? So even if you had a strategy that had really low standard deviation, but a really small return and required you to lock up your money for 2 years, perhaps for 2% per year, I don't know if you would do it. This is something that standard ratios like the Sharpe ratio or the Sortino ratio don't really take into account. You need to think about how long you are going to be locking up that capital, and because it prevents you from doing alternative things with it, which is really useful if you can take it out and do something else with it frequently. So, and then the other thing is scaling. So if you're trading illiquid markets, it's going to be hard to scale your strategy up and continue to make the same returns as you did before, primarily due to market impact. So you might be wiping out your own returns just due to moving the price. So let's say you make 1% per trade, but just getting into the trade, you move the market 1% in the direction that it normally would based on your signal. You're basically wiping out all of your profits on that. And so you can no longer really trade that with appreciable size. So in the case of this dynamic basket strategy, my holding time was only 15 minutes. So this is actually very good for capital efficiency. I didn't actually use the capital throughout the rest of the day. It was just the opening 15 minutes during these events. It would be a real issue if, for example, I had to lock up my money for 6 months in a position and I was not really making very much money. So even if the Sharpe ratio is really high, do you actually want that? Is it economically beneficial to you? Even if you're getting a Sharpe ratio of 3, but you make barely over the risk-free rate, is that really something you want? You probably can't borrow at the risk-free rate anyways, so this would probably not work out to be very beneficial. So just think about it practically and it should make sense. And as an example, my strategy here is not very scalable. So it's trading pretty not illiquid, but small cap stocks. So it probably wouldn't work on account sizes over 2 to 3 million. So that's something to consider. Although for a lot of small traders, it's not really going to be a big issue for some time. It can also be an advantage considering some institutions will stay away for this reason from certain strategies, and you can take advantage of that by being willing to work in that smaller account size for some time. So in conclusion, fees are pretty boring, except they're really important, predictable, and will absolutely ruin your strategy once you stack them up against the fees. So you need to do it because they exist in real life. The fairy tale sort of situation where you have no fees and amazing returns are not going to exist in real life. And if you want to make any money with these strategies, you need to actually put them up against the realistic situation of the fees that you will actually pay. The bottom line is that your average return per trade must exceed the average cost per trade, and not by an extremely small margin like half of a percent. It should be at least 0.5%, probably, if not more, especially as a retail trader, because you face higher fees. So for example, my strategy here in reality would probably not perform really well because it's less than 0.1% average return. And once you stack that up against fees, it'll just be wiped right out, especially for a retail trader. So is it simple to model your fees? Yes and no. I would say experience helps a lot. So over time, you will start to understand what markets have higher fees and which ones have lower fees. Generally speaking, futures are pretty inexpensive. That's why a lot of people will do higher turnover strategies on futures, because it's actually economically feasible, whereas equities are pretty expensive, especially ETFs. This is just something to keep in mind, and you could normally do a back test without fees and just sort of understanding your fee structure, just compare them in your head and back of envelope sort of calculation and throw out strategies before even implementing more complex fees. if it comes down to the line, basically, if there's a question as to whether or not it would work, that's when you want to look in deeper into what is my turnover? What are my average trades per year? Add in things like liquidity, market impact, and availability, and it should start to make more sense. So if it's a really, really razor thin decision, you might incorporate the question between capital efficiency and scaling, and then compare several of your strategies that you've developed and see which ones are more effective like this if you can't decide which to deploy on your limited capital. The reason I say limited capital is that, as you saw earlier, you don't really want to be paying high fixed costs relative to your trade value. So if at all possible, you want to deploy the most effective strategy. So one that can be scaled, one that has good capital efficiency, one that has decent returns, net returns over costs. And by doing that, this will help you lower your fees because you'll be paying less fixed costs relative per trade. So that's something important to consider, especially once you're constructing a portfolio. So yeah, check out the little calculator I made. I hope it helps some people figure out which tier of IBKR to use, because for me, it was quite confusing in the beginning. I actually wasn't so sure. My first instinct was to just use the tiered system because it looked like it would always be cheaper. But when you actually get down to it, it's not. It's a more complicated problem than it seems. Also, if you're short selling, make sure that you are checking for availability and short selling fees, especially with hard to borrow stocks. So this is a really big deal. I would actually potentially check it before you even develop the strategy if you're looking at relatively illiquid smaller stocks or stocks that are in high demand. So gappers, like in my study. Do this before because it will tell you if it's even worth it. If you see something like I did with 54% annualized borrow fees, that's probably not going to work with almost any strategy. I hope this was informative, and please do take the time to implement your fees properly into your backtest, and take note of things you notice when you're doing research. So if you research that this particular group of stocks is more expensive than the others in terms of fees, this is something good to know in the back of your head. It can save you a lot of time when you're developing strategies not to go down the road that will lead to, oh, these are too expensive. So yeah, bye.